Alright. So, welcome everyone. Had this PowerPoint set up, but I never finished it. But welcome to my spread class. I am going to go over spreads. So, what are requirements for the spread class? Well, you need a margin account, and the reason why I say you need like at least 2K because the minimum for 2K is required for most brokers. But mostly you'll only ever need like 2 to 5 grand. I mean, so margin account at most 5 grand. Don't touch the 2 grand base balance because then what happens after that is the broker will double that, your buying power. But you absolutely must be careful about the base cash. So that's your cash and sweep account. So pay attention to that amount. Don't look at what your broker says you have. The broker makes you look like you have more money than you should have. You should never ever trust that balance because that's calculating your risk and then how much they're gonna lend you. Like they always kind of beef it up, like times it by 2. But there's always downsides because if you're under, let's say you're under 25 grand, so under 25,000, you have the pattern day trade rule. So this means you can only make 3 trades in a rolling week. So, for example, if you trade on Monday and you are on margin, and you sell the same day, basically. You sell the same day. That means you used 1 day trade. And you cannot get that back until next Monday. So what happens if you use all your trades? Like the 3 trades in a rolling period. You used one day trade on Monday, and then you used it again on Tuesday, and then you used it again on Thursday. Well, that means you cannot get those back until your second one on Tuesday, your third one back on next Thursday. So that's what it means. But when you go over this, you have to be very careful. You are slapped with the pattern day trade rule. And I have to make this a sticker point in most of my groups I'm in that I support. I really hate when people don't understand the pattern day trade rule. And, I always try to clarify for them, you gotta be paying attention to this because you're under margin. Robinhood, RMAC, Yarnus, but they put you on margin and they're not very forgiving. Okay, that's a difference. With other brokers, they're forgiving. If this is your first time doing this, they will forgive you. I know because my main broker, TD Ameritrade, I told them I accidentally went over that and I could not trade at all. My account balance was negative. And I called them and I said, hey, I accidentally made a trade and it was supposed to be on my cash account. And they said, no problem, remove that. Don't do it again. This is like your first time. So, you know, they can forgive you like once a year and that's it. That's why you have to pay attention. E-Trade, I think it's the same thing as TD Ameritrade and Fidelity too. It's just that Robinhood is not very forgiving. Yeah, they have to make it fair for everyone. So if you get banned, you get banned. You cannot trade. And it's like for up to 90 days. So if you violate that, so I'll make a new slide. $90-day ban. Yeah, so it's not fun being banned 90 days from your margin account. You can't do spreads, you can't sell premium, and you cannot do anything. Like, you're just stuck. You can close positions, but you cannot open any. So that really sucks. So what do I use spreads for? So I mostly use spreads to sell premium. So I'm on level 3 in E-Trades. I'm using E-Trades because it's a lot easier for me to show you guys the risk graphs on their website. And I'm too lazy to open TD Ameritrade because I don't really access TD Ameritrade through their website. I use it through their desktop platform, and that's how I interact with that broker. So these are the types of spreads. So I'm only going over 3 today because I'm planning to split this up into like a series. So I'll go over 3 and then I'll keep trying to make more. So I'm getting a lot of questions. I want to answer them, but there's time I gotta repeat. It gets really annoying. And so I'm just gonna make a video so it helps people understand, like, how do I open and how do I determine what's a good spot. And since I'm mostly in the realm of probabilities, and to me, like, spread trades are like math. So I was a math geek when I was younger. I definitely had to like get C's in my calculus classes in college. But so we're just gonna go over 3, and my main focus today, everything you need to know about vertical spreads, iron condors, and we're gonna touch base on butterflies as the last topic. So let's start with a bullish call spread, or a call spread. So just looking at this, E-Trades tells me, okay, if you buy a stock and you think it's gonna go up, you're gonna be buying a strike and selling a strike. So if we go to option alpha, so it's really defined as this. Their vertical spreads are the most basic option strategy that serves as building blocks for more complex strategies, and that is true because I started with debit spreads and vertical spreads. Traders use vertical spreads as an option to profit from the stock going up or down or sideways in the movement of price. So we look at this, and so we buy a June 2000. Actually, let's do this. We're gonna do, okay, it's now September. I'm gonna say we're buying a October 2020 call spread. You buy the 150. You buy one. You always want to go small. There's a reason why I tell you guys. You always want to start small on your spreads. Because you don't know when the stock will go up or down, and it's going to fluctuate. Every time you see the stock go up and down, it also affects your spread, your call spread. Like your debit spreads, So this would be a debit spread. Yeah, debit spreads are like there's not much room for error for these because you have to be right, and that's why I hate about them. You have to be right about the direction. But I'll talk about credit spreads later, and that why I prefer them over debit spreads. So you're buying 150, you're selling the 170. So let's say, yeah, this whole spread right there is only worth $1. You pay $100 for the spread, and let's say the price goes up. You paid $1, and so as you in time the stock goes up. The one you bought goes up. The one you sold also goes up. So let's say this one expires next month on the weekly, and yours is for next month. You bought it $1, and now it's like 115 basically. So you're up. This thing has increased in value. So what I wonder I can draw. So I'm gonna start drawing. So I'm gonna do paint. So let's see, 150. So 150, this one right here, let's say it was $2, and this one was $2. This was like 100, so this was your net cost. Net debit was $1, and then like stock's at 165 now. So 165. Let's say this one is now, because it's in the money. When you bought it, the stock was 140. Let's say it was 140 now. 155, so this one's deep in the money now, so this one will probably be like, I don't know, let's guess, this is like $7. $7 now. And this one right here, well, this one also has increased from where you bought it at. So this one, let's say this one is now $5.65. So minus this, this is one you sold, this one you bought, this one you sold. So let's see. So $2.10. That's pretty good for profit. Would you want to take this, or you want to go to max profit to October? Let's say the max profit for this one, if the stock is trading at 180, the max profit for this is to like at least 1,000. Actually, let's put 800. 800 sounds reasonable. So max profit 800, and your expiration is 2000 next month. Would you want to take this or this? I would take this because I made money already. It's $1.10. I wouldn't want to keep this too long. And like, let's say I was holding it for 140. And like I suffered the stock going up and down, like a madman, and I was consolidating really hard, and I was getting pissed. I would take this over this because one thing I do sometimes when I'm swinging long term, and I'm really swinging long term on these Costco ones, I think Andy was asking me that. I was like, what about Costco? Yeah, I'm in Costco. I'm down in the gutters. I guess look at next year's Costco's. So I'm in the gutters. Don't worry. I'm still in it. I'm still waiting to break even. I'm still waiting for Costco to make a move up. then I can probably sell. I have a naked call and I have a put. I have a naked call and I have a call spread. So usually you have at least 4 types when it comes to vertical spreads. So you have the bull call spread, the bull put spread, and the bear put spread, and the bear call spread. Basically, what these all mean, these bear put spreads and bear call spreads, that's just credit spreads. So usually I don't call them. I call them by debit and credit. You hear that from a lot from me, how I do it, because I personally don't like those terms. It's either debit or credit, so that's the only thing you see from me. Because I want to be right about the terminology and what you see from other people. So you don't get confused when you see like bear put spread or bull call spread or whatnot. Just don't mind it. Just call debit spread. Or it's a debit spread. It's a credit spread. Okay, so I'll put a link in the video and the description so you guys can read all this. So let's say you bought for 150. Okay, so you buy the 150 for $9 and 30 cents. And you sell the you bought the 150 call option for $1.54. What you pay? Well, it's the difference. So the difference is $7.79. I'm not paying that. I'm too cheap. That's not my strategy. I don't pay anything for a spread, a debit spread over $2. That's my max. I'm not paying that unless it's Google. That's an exception because Google can pay. Those premiums can go up like pretty quick if you're on the right side. But that's something when you get a bigger account or you have money, trade Google. I'm telling you, it makes you money and nice returns if you know how to close it. So let's see. So you guys all can read this. I'm gonna put a link in the description below. So this just tells you like if you're bullish, this is where the stock's going. So if it's bearish, so let's do puts. So put spreads. You think the stock's going to go lower? You're going to be... So the stock's going lower, you're going to buy a put debit spread. That's what you think, okay? So that's your first option for a put debit spread. So if you know the stock and the market's going to go lower, you just buy this. Okay, so, and yeah, that link in the description below explains all this. I will put a PowerPoint for you guys so everyone can see and they can follow along. Oh, I haven't touched base between what is the difference between the cash account. I think I touched base a bit on cash versus margin, but cash account, you are not under PD rules. It's just based off what you have and it clears the next day. It's just different from margin. So no PD rules, just trade cash. Start with cash. You know, you control your balance and your emotions better when you have cash. It's provided you don't go big. So, okay, so another thing I do, most of the time I'm a premium seller. And what I like the most about being a premium seller, I usually do XPX or SPY. I usually sell premium, so I'm usually on credit spreads a lot. So you see many of my posts are just credit spreads. So I can just talk about one that was successful. So I can just go. I think I can just go to. Let's see. So I just had one that expired this week. I'm not sure if anyone followed me on this one, but I got credited about $10 for this credit spread. So my risk to reward was great. And I opened this on Monday. So if you stack these are high probability trades because you have to know, what's the expected move, where's SPY gonna go. So this was really high probability for me and it was successful. One thing. So right now, we have a base for understanding vertical spreads. So I'm gonna show you guys how to construct them because I see a lot of questions, and also like E-Trades offer these tools for you guys, so you guys know, your probability of profit. Like you have a probability calculator, and it's really good if you're doing spreads because you want to know your probability that if you're a premium seller, if it's going to be out of money. Because most of the time, I want my things to be a piece of shit when I'm selling credit spreads. I want them to be a piece of shit. Why not? My man's trash is not my money, my treasure. So that's why I like the most about credit spreads is because I like to know if things are going to go out of money. So you can do this yourself on E-Trades or another broker. Let's do. Find strategies. So it's automatic set to 30 days out. So calendar spreads. So I will talk about more about calendar spreads later. That's something. Let's do bull call spread. Short put, married put. I don't even know what these mean. I don't even know what's a married put. That's dumb. Okay. I will go to SPY. Because I can just construct it for you guys and you can see, what's the difference. And if you're bullish on SPY, I recommend like you have to go at least 3 days out, and what you want to do if you're bullish, you want to like go one in the money and then go one out in the money because that's more profits if you stay that way. But most of the time I don't trust SPY, and this is what I would do if I'm bearish. If I'm bullish, I will consider selling premium. So this is what I do. I would sell premium and I would just do like 117 because I want to be $10 away or more from the money. And I always like to kind of like go with the trend right now, so I know SPY's going down, but these premiums right here, we have a lot of support on SPY right now, and I still think that the market is just finding directions. I would do a credit spread because there's 3 advantages when it comes to credit spreads. The stock may never reach your strike and you still make money. The stock can range trade and you will still make money. And another thing, if the stock sells off but never gets to what you are, you still make money. But with a debit spread, you always have to make sure you're right because the market can bounce. So you have to really plan these out for debit spreads, and you just cannot just put one random one like what I'm doing right now, because with debit spreads you have to be really close to the money, so that way your stock can go in the money. I know these rules don't apply to like Tesla or big IV stocks, but I'm just looking this from XPX and SPY. I like to be very far away, just because I like to play it safe, because I know there's a lot of premium on these. You should be looking at these as, so let's do SPY. Okay, so let's, just look at how much premium they have on these tickers and how much you can afford to sell all these premiums, because you know that in the end, if we don't reach in the money by these dates, like, can SPY go into 226 next week? No, that could be a possibility, but that's more of a gamble. So when you're doing credit spreads, you are the house and not the gambler. So that's why I prefer this method more, because I have 3 advantages and I don't have to be right. So before we go, we can have questions real quick, and if you guys don't understand, shoot me a DM and I'll explain that. So Back Mamba asks, hey Tiff, are you taking both buy and sell in the money for premium? So can you clarify what you mean? Like, are you talking about credit spreads or debit spreads? Because if I have never done one in the money for credit spreads, I know there's more money to be made if you did in the money, but that is just taking a huge risk, and you're risking yourself being assigned those shares. So since this account is small, I don't want to do that. That's a huge risk. So we always want to be risk averse when you're doing credit spreads. Okay, yeah. So you want to be risk averse as much as possible for credit spreads, because anytime the market can drop, the market can go to your strike. It has happened to me before. So, and it kind of leads into iron condors for me for this. Like, if I'm doing iron condors, let's go into the strategy optimizer on E-Trades. Actually, I hate this one. Option analyzer. Let's do this one. Okay, so this is the risk graph that I talk about sometimes. Actually, I've been trying to talk about the risk graph all the time for the Robinhood people, because when they do them, they don't really understand what's the risk graph, when did they break even. So I do have a position in Disney. It's mostly I have stock, so that doesn't really apply, but let's do SPY. So if we are doing a put credit spread, okay, so Dave said, can you get out of a credit spread anytime or at expire? Yeah, you can. So I'll make a video when I'm gonna do one, like how I close it out. But most of the time when I'm doing SPY, I let them expire. Because I pretty much nail the trade most of the time because I know that these premiums will contract a lot. But if you want to get out, you have to click close on the ask. Because when you're doing a credit spread, you're doing it on the bid. So if there's no bid, you can't really sell it. So a live example. So I will do a live example. If I'm bullish on SPY, so I usually do a put spread. So I just change this to sell to open. So it automatically does buy to open. So if I did that, I am going to change this. So SPY's trading at, I think like 340. What's SPY at right now? Oh, 340, yeah. So I want to do 325 and 324, or I can just do 326 again. So analyzing the probability risk graph. So if SPY stays above, like right here, and so this is calculating the standard deviations. So you have 1 standard deviation, 2 standard deviation, and 3 standard deviation. So here I get the ask is 10, but the bid is 5. So what I do is I look at this as too little for credit because I got paid commissions. What I could do is I can make this wider. So let's see. Oh, make this wider. So I would collect more credit, but looking at the spread right here, I have to offer at least 500 of collateral to collect $23. So that's not bad. It puts me like right here. And just by knowing if by September 14th, if we don't get to 326, I get to keep this credit of $23. Nick asks, how do you manage a stop loss? So if it's not like so I did something similar for Chewie the other day. I had to stop out of my trade. It was really hard basically to get out. So I was trying I think for 2 hours straight. Chewie kept falling. And then I was trying to trigger my stop loss on that. So I ended up trying to do a market ask to close basically, and that's how I got out of that trade before I lose off any money, before I was gonna get signed. I lost in that trade because I broke kind of even, so I was not successful. It was successful if I could close it. I was trying to close it the other day too, and this morning as well, but it was not gonna happen basically for me. So to manage a stop loss on a credit spread, it's pretty tough because you will be fidgeting around with the spread. And so, I was bullish for Chewie. I was thinking Chewie could go up, but Chewie kind of met the expectations. and then we never got there. So this was a disappointing trade, but overall, the call side premium was so jacked up. I did really think about selling the call side premium on Thursday when they had earnings. And then I just told everyone, I think, you could sell premium on these because Chewie was expected to move $9 up, and that was not possible for the stock because it only moves $2 in a day. Yeah, so Black Mamba, yeah, if it's bearish or bullish, you want to go the opposite way. You always want to, give yourself some breathing room for the stock. So, so if it's bearish, if you're bearish in the market, you want to switch to the calls. Same rules apply, except that now you're going to try to find where we have resistance on the stock. So 340, we can go 340 and 342. Oh, sorry. Okay, so this is $2 line. The bid's at 11. The ask is at 15. If you're bullish in the market, you can buy this. You can buy this for 15 cents. Or if you're bearish, you can sell it for 11 cents. And I consider that a good deal. If it's a 10 above credit, because you're just risking 100 to make $10. But if you stack them, the key is if you stack them. You offer $100 of $1,000 of credit. Collateral up front to make at least 110. And in a day, you're guaranteed to collect that. You don't get that with debit spreads most of the time, in my opinion. I have done so many that you're never going to guarantee, unless you get yourself a time on these debit spreads, the full premium that you are going to collect. I just find it easier to collect premium than trying to pick a direction with debit spreads, because I don't really have to pick a direction with credit spreads. So I think we're done with that. And now I'm going to go over iron condors. So iron condors are what they sound like. If there's a lot of volatility in the market and the market's not going anywhere, you want to capitalize that. You want to collect premium. So, what is the iron condor? It's between two different areas where, you don't think the stock's going to go here, or you're just going to think it's going to be in this range right here. So, that's a difference. So, let's see, this one. So, I would never make an iron condor this wide. And usually when I do iron condors, I mostly do them, I do one side at a time. The reason why I do them one side at a time is because when the market in the morning on these condors finally pick a direction, we could sell off in the morning, from my time, 6:30 to 8, and then we can rise back up. But mostly when I see we sell off, I buy a put spread. I buy a put credit spread. I try and nail the bottom, near the bottom of those contracts, basically, to the point where I'm pretty much out of the money, but safely I'm selling these. And then when we go back up, I know the stock will go back up because there's always going to be this hard little bounce. And then we top out, and then I'm going to be doing the calls. And I rarely do these because they're so hard, because it's when the market moves a lot and volatility is a lot, it sucks. Because you are teetering and you're risking a range. You have to make it wide enough so that range does not get broken. Because you have to be in the range. So you only make money when you're in a range. So let's see. If I did like 320, let's see. I'm gonna do 341, and then I'm gonna do 342 if I did that, and then if I did 330 and 331. So net credit you get is between 12 and 24, basically. So this is the profile that you're looking at. So I think I messed it up. Oops. Okay. Okay, yeah, I did mess it up. So this looks weird. Sell to open, buy to open. Okay, so let's do this. Okay, so this is a, ideal world, perfect iron condor in my opinion. You only risk, what, $100 for this range? You stack these, you get $27. So you stack about 10 of these contracts, plus commission. I know some people are capped, but this is a good range. Because you are at the edge of one standard deviation and two standard deviations where you're right here right now. Actually, this one might be uncomfortable in a sense, so we probably will price this much lower than that. So let's go 228. Buy the 327. So yeah, so I usually like to place it like this, basically for a good iron condor, because I prefer breathing room. Yeah, breathing room like between like 1 and 2 standard deviation is the best, because when you nail it, if the stock keeps going in this perfect range, because you can actually do this yourself. I've done this multiple times. You stick yourself right here, and that would be a good iron condor. So I stick these like that, so I probably would paste this in the spreadsheet, the PowerPoint, before I lose it. So I'll do that along with the strikes. I know this doesn't sound like exciting because it's boring and you're selling less than what you make, but if you're looking for income, $17 is not that bad. You can go closer for your own comfort and collect more. But then, like, what you do is like you just go nuts crazy as the time goes by. Your contract on the same days, those 0-day lottos go by. Time to cake eats them. You're just gonna be like looking to sell until the stock kind of like stays in a range. But you have to be careful. Contracts can get exercised by, I think my time, 2 o'clock or 2:15. Okay, so questions. I'm gonna stop for questions for a bit. And Day said, "Yeah, you can pull this 3 times a week on SPY. Do you normally see 10 credit, or is that same day or a 2-day expression?" Um, I see a lot of them. You can get them 10 credit. It's just like you have to mind where you place your strikes, and so I'm trying to do more on this account because this account is just margin only. Can't really day trade this account. So I'll post more examples and you guys can follow these credit spreads so that way someday you can understand where to place them, basically. You always want to be between 1 standard deviation and 2 standard deviations. So this is like considered a really good one to correct this type of condor or credit spread. And even if you didn't want to do a iron condor because they're really hard, you always want something that has 80 or above chance of success of making money. 80 or above is pretty good, because that means these things become a piece of shit. And you just collect the credit. And you only offered, what, $100 of collateral to do these for this range? Gerb X says, I'm on Google calls from your alert and option sauce. Do I average down? I don't know. You can get out if you want. I mean, you gotta manage your risk. So if you're down that much, you have to cut, learn that cut. I mean, I can't help you on that. Iron Con, so Shibit, sorry I'm butchering your name. Shibit Makalas. I heard Iron Condor is good for ER, for any reason. So, they can be good or bad, but they're pretty risky if you don't know how to do them. Like, I tried one before on ER, I lost, and that was Intel. That was last year. I never done Iron Condors on ERs ever again. I just did credit spreads. I just picked one side. But the reason why you could do Iron Condor is because then they're fixed in a range. So if you know the range of that week and plus earnings pricing in, you understand. And then how the stock can move in one day. I always stress that you gotta know how much your stock can move one day. I don't know. If I don't know how much can move one day, you can go to Finviz. So, like, let's say you're going for Peloton and you're looking at earnings, and they can move $6, $78 a day. So, you look at that, you just know that the stock can move. And then if they're pricing in like it can move $12 a day compared to $6 a day, so you know that. Okay, so that's really a big move for Peloton. So that kind of explains Iron Condors, and now you pick them. So, and then this is like probabilities, more probabilities. So 7 chance buy will close below 327. That's tomorrow. And 80%, 85, 86% SPY will close between these ranges right here by tomorrow expiration, and 7% chance SPY will close 340 by tomorrow. So next one, kind of cover it briefly, but I do use these, and I did use one the other day because I was trying to be bullish on Beyond on Friday, but last minute I converted my put credit spread into a butterfly. So I can go over that trade. So let's go over spot Beyond. So we're gonna do a butterfly. So if we do a butterfly, this is kind of close. So, this right here, that will make you money. So, we want to find a really good one. Okay, so 327, 20. Okay, this would be like a broken wing butterfly. This one's deep in the money, so usually what I do is I have to move it up a bit. Okay, so not very even, but It's not gonna make me any money on this. Oh, wrong way. Beyond trading at 130. Okay, puts. Let's do this. Wow, that's not gonna make me money at all. Okay, so the max profit on this I can make $32. I'm not happy with that. Let's delete this. So we can do this. So we're gonna go. So Beyond is trading right here, and Beyond can move a lot, basically. So we can do 134, we can just break this one, 134, and then we can sell 129, and then buy the 124. So we're gonna make this wide enough. So this one right here, this is saying that Beyond is gonna move and kind of like stay in this range, and then we're gonna be have a success rate right here, but it's pinned to this point. Like, it has to be like right here. Look at above this point right here. But the chance, this strategy has 14% probability of making money. We don't want that. We want more profits. So we're going to be playing around with these. And then we're going to keep moving them around. So 134, we're going to try 130. And then we're gonna probably do this, so let's just do 122. So this one's a little wider, but it's just like really far away from the money. Will Beyond get there? I don't think so. We have to look at Beyond's chart, basically. So trading view, and look at Beyond. So Beyond has a lot of support at 112 and 120 area. So if we tap this area and Beyond, this won't work. So if we're bearish on Beyond, you have to pay a net credit of between $45 or $8. So that's not good. We're never gonna get break even on these because it just looks too expensive. So as we continue to play around and try to find a good butterfly trade for bearish, you start to notice that as we come close to right here, we always want to try to like find a good point where we can make money. Usually when I do butterflies, I try to stay within one standard deviation. And then when it goes there, I try to take half profits like right here. Like mostly, let me screenshot this. And again, I'm going to post a link to the PowerPoint when I'm done. So if Beyond keeps selling off and I buy a butterfly, I'm gonna take profit in this area. I'm never gonna like take profit at the peak, because I tried that one time on LRCX. And it was so hard to get out. So LRCX was like going up, and I put a butterfly trade, and my break-even price was like 300, and then I grabbed like the 320. 380 because my strike, because the one I was selling was 300, and then I put the 310. So 310, it shot up and it was at 309, and it was like so hard to break even on that day, so I just let it decay a bit. And where I took profit was like right here, basically. Like it was like right here when I took profit. So that was the part where I took profits. That where you kind of have to take profits before it keeps spiking up. Because when it goes, and because you can't lose money when it goes above your strike price. Like let's say it keeps going up. This is how much you can lose. You can lose $800. And that's why, like, for butterfly trades, yeah, I do them, but they're rare. I don't do a lot of these. I only do it when I'm in a pinch. Like, if I have to put a put credit spread and then, or a call spread credit spread, and I'm in a pickle, I have to be quick, and I have to convert this into a butterfly trade before I lose money. Because on Beyond, I only lost like $20 compared to like using a full premium and getting the risk of getting a sign. You know, $20 is nothing compared to losing 100 and then the risk of being assigned. So I use these as a safety measure when I'm wrong about a trade. So that's when I do these butterfly trades. And someone asked me a few days back, and he was like, "Hey, I'm in a credit spread. I'm in the wrong direction, and the stock going my way. What should I do?" Well, I told him, convert your thing, be quick, do a butterfly. You're gonna lose. You're gonna be profitable if it reaches this point, but you're also reducing your risk. You know, you can lose $100 on these like $1 wide spreads for a SPY. But he was not doing SPY, he was doing something else. So that's what I told him. That this is how you risk manage and save yourself if you're in a put credit spread or call credit spread and you're in the wrong direction, basically. So this is what I do to save myself. Lose $20 or make a profit. So I'm gonna stop here for questions for credits, the butterfly. And if you guys have any questions, I'll answer. But I don't do these a lot. I do these to save my ass, basically. And you can do these to save your ass, because this strategy has saved my ass multiple times when I'm wrong. Like I still can profit if I manage this and I convert it into a butterfly trade. Cause like when Beyond dropped, I was like up $20, and then I couldn't close it. If I could, I would close it for plus 20 instead of taking the $100 hit. But I ran out of day trades, so I'll just put this in the PowerPoint. So, if you guys have any questions, please be free to ask. If not, I'm just gonna end the video here, and I'll see you live chat tomorrow. And so, the $300 account challenge starts tomorrow. So that's for it for today. I'm gonna do the PowerPoints, and then I'm just gonna include like a summary of what we talked about. So let me know what you guys think, and have a great rest of your weekend. And I know the future is gonna start in 5 minutes.